Hello guys, thank you very much for being here tonight. I really appreciate it. Hopefully I didn't mess up the sound at the beginning this time. It's pretty exciting. Alright, so once again thank you for joining. My name is Petri Riedelinges. I will be doing some stuffs with you. Once again, just a reminder, please join the Discord. Let's chat in there. There are mic is working, Christo. I see the mic is working. Is it not? Let me know. Maybe you're reminding me to put the mic on because it hasn't been on for some time. So anyway, if you have any charts that you want me to look at to use as examples, then please send them, drop them into the Discord, and I would be too happy to use them. But what we're going to do tonight is we're going to try and go through almost a summary of the stuff that we've done over the last couple of sessions, to try and bring that all together into how these things are all related. Some of the stuff may have seemed unrelated to the rest, but tonight hopefully we tie them all together and show how these things are used together as a tool set essentially. And to use examples of these things throughout the course of the evening, I want to use charts that you provide me with. So pick shares, send stuff, use either the YouTube chat or the Discord, and we will do that, and we'll get to them. So we've got quite a bit of stuff to work through this evening, so I'm not going to waste any time. We're going to get straight into it. We're going to work this evening through a number of things. We've got a whole bunch of slides that we want to get through here. This is basically just some of the stuff that we've already covered. So starting off with, I suppose I could move a little to the side, whatever, who cares. Okay, starting off with the first thing, we are basically looking at a couple of stuff. Dow theory, trends, where in those trends is then best to place your stop losses. We'll get to that. Support and resistance, ways of identifying support and resistance, and so on. Chart construction, these are candlesticks, bar charts, that kind of stuff. Also different ways of doing the axes, and then some oscillators as well as moving averages. And then we looked, remember, at the building blocks of a trading strategy as well, basic risk management stuff, and then a trade logger. So we're going to put all of those things together this evening, hopefully. So starting off with Dow theory, as we remember, the market has three basic moves. I'm going to very briefly go through this stuff because we have a lot of stuff to get through, and I want to try and get through this in as short a period as possible. If I go too fast, let me know, ask questions, and we can deal with them as they come up. In any case, so basic tenets of Dow theory. There are three basic movements. Trend has three phases. The market discounts news, and all the averages must confirm each other. Most important points here: trends are confirmed by volume, right? So there are the three main movements within a trend are the main move, the medium swing, and the short swing. The main move is the longer term movement that the chart makes. The medium swing are the pullbacks, and then the short swing are sort of the intraday or kind of very, very short movements. So a primary trend or the main movement can last anything from bit less than a year to several years. The medium swing is a shorter term reaction which can last anything from 10 days to 3 months, and the short swing is a minor movements from a few hours to a month or more. So those are the types of the three basic different types of trends that you get. Trends are confirmed by volume. This is a very important point to make here. So trends are confirmed by volume, and we want to see volume moving in the direction of the trend. So when volume is increasing while the price is rising, that is a bullish sign. If volume is increasing while the price is falling, that is a bearish sign. And conversely, if volume is falling while the price is rising, that's negative or bearish. If price is falling while volume is falling, then that is bullish, right? We'll get into that a little bit more when we look at on balance volume. Somehow very soft tonight. I did mess around with my mic by accident, so I'm going to try and turn it up a little bit. If it gets too loud, I'm sorry. Tell me if that is better, Heinrich, sorry. It is a little louder now. So okay, So basically, yes, we want to follow the trend and we want to have volume on our side to confirm that trend, right? Determining the trend, very basic stuff. We have higher highs and higher lows, which is a bullish trend. We have lower lows and lower highs, which is a bearish trend. We need 2 consecutive of each in order to confirm that the trend is in fact in that direction. Then moving on to support and resistance. We looked at support and resistance are basically areas in which supply and demand meet each other. Support and resistance is, or support and or resistance point is a single point where there are a large number of orders or a large number of transactions that take place, and the market can sort of consolidate around those areas or reverse at those areas. A resistance or support resistance level or zone is when multiple of these individual points of resistance are at the same sort of average price or range of prices over a period of time. Then we start seeing, as we can see on our example here, we can see A is a point of resistance, C is a point of resistance, D is a point of resistance. Together they make a zone of resistance or a resistance level, and the same with the Z, B and E here. All right. Identifying these support and resistance levels or points, individual points, we started with the DeMark or Williams method is what it's called. It is using the number of bars on either side. These are looking at bar charts. It's using the number of bars on either side of what your suspected resistance or suspected support bar, or low bar and high bar, or high bar and low bar in this case. So the high bar would be your suspected resistance level, your low bar would be your suspected support level, and what you do is you look for the candles on either end of those, just before and just after, and you're basically looking for these candles must, or these bars must basically have lower highs if it is a resistance level. If the market is moving up and you think that you have a resistance level, candle on either end must have lower highs than the one that you suspect is your high, and the converse applies to the low. If the market has moved down and you have a suspected support level, the candle on either side or the bar on either side must have higher lows than the one before. So there's a couple of examples here that we worked through in the past. Then there is the 2-day the Gann 2-day swing method, which is basically the exact same as the method we just spoke about, except now you basically observe for another 2 days and you would like to see a little trend forming. Basically, you identify the individual candle that you think is a support or resistance candle, and you identify the 2 bars on either side. You see on either side you have higher lows. If you are looking for support level, then you observe for another 2 days, and if those 2 candles each have higher lows than the suspected support candle, then you have a support point, right? So these are basically how you determine support and resistance levels. We then looked at how to trade support and resistance levels. One, by identifying them, you can then enter into a short and or long trades depending on how the what the setup is on the chart. And we looked at basically trading inside of a range, where if you have resistance at the top and support at the bottom, you can enter into trades long and short. Doing that, what was handy, we looked at as well, was to use consolidations around support and resistance levels. So on the previous slide I'd mentioned that there are when the market moves into a resistance level or zone, sometimes consolidates. In that consolidation, when that consolidation breaks, we can then take a trade based on that, and then we can look at aiming for the other end of that support and resistance level. So in this particular case, we look at a stock, right, as the example. It has a bit of a support and resistance, or it's come down to a support level, and then consolidates around this level. When that consolidation breaks, we can then take a long, and then for context, this is the longer term. So we have a resistance level here, a support level there, a nice range that is trading in between. When it consolidates like that, we can move to a shorter term time frame to get confirmation that this range is broken, and then we can trade, or that the consolidation is broken, and then we can trade the bigger range. Right, any questions up to this point? I don't see any, so I'm going to keep going. What did Christy send us? Sunlum. Alright, we'll use Sunlum when it comes to the oscillators. Actually, alright, stop. I am going to stop here because I want to look at some examples. So we are going to look for support and resistance levels, and we are going to look for trends, and that is it. Okay. So looking at something like first rand, as we can see here, the trend is very clearly up because we have higher highs and higher lows consecutively, right? We can then draw in our trend line from say there to there, and we can confirm with this trend line. We're going to make it nice and to make it pink. I don't know, pink is always the go-to color, and make it nice and thick. And we can see here that we've got higher lows the whole time, as well as higher highs, right? So we definitely have an uptrend here. This is our primary trend, this is our secondary trend, and then in here we have our tertiary trends, which is the smaller movements. So we'll zoom in a bit to see tertiary trends. So that those moves here are all tertiary trends. So from there to right, from there to there to there. These are all our tertiary trends. You can see how shaky they are. Our secondary trend is this trend. Our secondary trend is that trend over there, and our primary trend is this long, big, fat trend at the bottom here. Right? So we can see here that the trend is up. We then also would like to see support and resistance levels. So let's have a look at the DeMark and or the DeMark or Williams method. I need to remove the and, always do that. Here we have a low bar or a low candle, and we look, is this a significant support level? Yes, there is the candle just before it, or the bar just before that, has a higher low, and the one just after that has a higher low. So that is then in fact a confirmed DeMark or Williams method low bar. And then if we apply the Gann 2-day method, we then look at the next 2 days, which is these two candles, and we can see that both of them also have higher lows than this one. So this is then a confirmed support point. We can do the exact same with this candle here. We can do the exact same with this candle here, and this one failed, but this might be the low here. So we can see that, hey, this is quite a significant support zone and or level, so we can mark it. And ironically, if you go look back, you will see that that is support and resistance for a long period of time. Similarly here, we have resistance. There is a high on both ends of this. The highs are lower, so that is our high point, so we can mark that. And then here is another high. Both are both are, according to the DeMark or Williams method, lower highs on either end. The same here, the same here. And if we mark off every single one of these candles individually, we are going to end up with a rather messy chart. But what's going to happen is we're going to end up with a sort of a zone if we do it very diligently. I always forget where to find my rectangles. Anyway, we're going to end up with a bit of a zone. Where's the rectangle, man? I'm trying to find the damn rectangle. There you go. We end up with a zone that we know is our resistance zone, and likewise we do the same with our support levels, right? So we can then look for consolidations in these zones to trade the range. Okay, so if we then go to shorter term time frames, let's say we go to 15 minutes, and we zoom out a little bit, and we can see, okay, here we enter into the zone, and we have a bit of a consolidation here. That's a very short consolidation, breaks out, comes back into it. So you can even then say that this is a consolidation from there to there, and a break above that would be a long. We now have a move that failed to get to the top. We are once again inside this support zone as indicated by our fancy blue block. So I'm going to just delete that because this chart is getting nice and messy. Go away, go away. And we can say that here we once again have this police, they're coming for me. Here we have support and resistance levels once more. I'm going to put that in there and that in there. And if we have a break above this level using a 15-minute candle close, then for example we might have a trade back up to the top of the range. So if we then go back to our daily chart, we can say that we now have a potential trade from here back up to this level if this thing breaks higher. Alternatively, if it breaks below this range, then or below this consolidation, then we want to be short, right? All that stuff makes sense so far, because that is up to this point what we had covered. Alrighty, okay, moving on. Then we looked at different types of charts. Line charts is one. Basically, we're just kind of going to move very swiftly past the stuff. Line charts are very easy to read, very easy to identify trend. Bar charts are a slightly better representation of what price action is like. There are the different ways that bars work. We put the stuff up on the Discord so you could see them: open, high, low, and close, which is essentially the same thing as candle charts. Candle charts are probably just a bit more popular because they're easier to see. And once again, we've got an open, high, low, close situation happening with the candle charts. We also looked at some candle patterns. There are some bullish and bearish candle patterns, bullish engulfing patterns, reversal patterns, all sorts of stuff. This was also shared in the Discord so that you could come and have a look at it. We then also looked at the different types of scale: an arithmetic scale versus a semi-logarithmic scale. Arithmetic basically is where every price increment on the axis is exactly equal. So from 1 to 2 is equal distance as from 2 to 3. As where a semi-logarithmic scale, it adjusts for percentage. So for the move from 1 to 2 is a 100% move, as where the move from 2 to 3 is a 50% move, and therefore will not it will draw the line slightly differently. To show you an example, we're going to use, we might as well then move to Sunlum, because that is our example that we were given. Sunlum and water. Right, so here we have scales. We use a log scale. And basically now over time, as you can see, when the stock price moves from 16 Rand to 18 Rand, it's the same as the move from 18 Rand to 20 Rand 50, which is then the same size to 23 Rand 50, then to 26 Rand 50, then to 29 Rand 50. So the moves in price terms are getting bigger, but in percentage terms are staying the same. So if you look at the way that this chart looks versus if we change the scale to a normal scale, how that chart looks, it's a very different story. We have a much steeper trend line here from 10 Rand all the way up to 70 Rand, as where if we do if we use a semi-log scale, it's a much smoother ride. It's less sort of parabolic. It just kind of smooths it out because in percentage terms it is the same. So the rule of thumb was that if you are looking at longer term stuff, I am doing charts and you are not seeing them. My apologies. Here is the semi-log scale, and here is the normal scale. So you can see here from 10 to 15 is the same distance as from 15 to 20 is the same distance as 20 to 25, 25 to 30, and so on, right? As where if you look at a log scale or a semi-logarithmic scale, you can see that from 1280 to 1440 is the same size. 1440 to 16 is the same size. 16 to 18, 18 to 2050, 20 to 2050 to 2350. The values get bigger, but the size is the same because percentage-wise those moves are the same, and that's what's important. That's why you have a much more accurate representation of what the share price movement really was, particularly over a long period of time. So these are handy when looking at long-term trend analysis rather than shorter-term trend analysis, right? Okay, then moving on. We looked at moving averages and how to calculate them, the differences between simple and exponential moving averages. We did some maths there, it was lots of fun. The same with exponential moving averages, and we came to a couple of conclusions. One, simple moving averages are slower to react to change, but are better to identify areas of support and resistance. Two, exponential moving averages are faster to react but are not ideal for identifying support and resistance. So both had their pros and cons. We then looked at different oscillators. We started with the MACD. MACD basically stands for moving average, convergence, divergence. It takes two moving averages and turns it into sort of a visual momentum based indicator that we can see, right? So it looks at what the trend is as well as what momentum is doing. It consists of a signal line or a crossover line, a center line, and we look for divergence, and there's also a bit of a histogram to it. Basically, how to calculate it, we looked at the different sort of, well, the only really method, which you have three things that you have to calculate: the MACD line, the signal line, and the histogram. The MACD line is basically a 12-day exponential moving average less a 26-day exponential moving average. That value is then plotted every day. This gives us sort of a trend, indication of what the trend is doing. Then we on top of that, we put a 9-day EMA to act as our signal line. So when those two cross over, we could potentially have signals to buy and sell. And then the histogram basically shows the difference between the MACD and the signal line, which is a bit of an indication of what the momentum on the stock is. And then the standard settings on that is thus 12, 26, 9, which is the setting that we use for most of them, which is the standard. So if we add a MACD to this, it's so ugly. Yes, we're going to make everything a bit thicker. We're going to make our histogram green. We're going to make that blue and red. Yeah, no, make it blue and red. Okay, and we'll zoom in a little bit. Alright, so what this blue line is then indicating to us is the 12-day EMA less a 26-day EMA. Our red line in this case is a 9-day exponential moving average of that, and our histogram is the difference between the signal line and the MACD line. Okay, so what we look for is we look for divergence in this indicator and price. So when price, for example, is making higher highs, but the MACD is failing to make higher highs, that could be potentially bearish. If you see here, price is making the MACD line here is making lower lows, yet our price is making higher highs, that is a trend continuation signal, and thus relatively bullish. Okay. Right, so we're going to move on from the MACD to the RSI. We're going to look at this again. We looked at how to calculate an RSI again. So RSI is basically 100 minus the 100 over 1 plus RS. RS is calculated as average gain divided by average loss. We did a whole spreadsheet on this. I'm not sure it's necessary that we do that again, but basically we looked at how these calculations adjust for a momentum. So we want to basically measure the speed of the change of price movements. It's a very popular momentum indicator. It ranges between 0 and 1, and it basically tells us what the rate at which prices are changing, right? So I'm just going to move down a little bit. So basically what we do is we have two separate ways. We have to start it at a certain point. So the very first calculations, we basically plot a simple 14-day moving average, and then we look at the average gain over those 14 periods. So we sum together, we look at 14 periods, and we add together all the days that it was up, and then we look at the average gain on those days, you know, what the difference is between the previous close and today. Over those 14 days, and we divide it by 14, and we call that average gain. And then on the average loss days, to work out average loss, we do exactly the same. So over the first 14 days, on every day it was down, what's the average divided by 14, and that gives us RS. Our calculation is 100 minus 100 over 1 plus RS, right? Then what we do the second data point. So that's how we've calculated the first data point. The second data point, we basically take we now change the average, the RS calculation to the previous average gain, right, times 13 plus the current average gain divided by 14. So whatever our calculation was that we worked out first, which is the average gain of the 14 added, or the every gain over 14 days added together, average, well, added together divided by 14, right? We now take that value, we times that by 13, we add today's gain if it has one, and we divide that by 14. The same applies on the negative, and this gives us a bit of a smoothing technique to try and figure out what the momentum is, right? So we can then allow this thing to oscillate between 0 and 100. That's just the way the maths works out, and that gives us a good indication of what the momentum in the stock is. So to change that, or to illustrate that on a chart, we're going to go to this. We're going to remove our MACD. We're going to add our RSI, relative strength index, and this is so ugly. We're going to make it pretty. Make it green. And this is what it looks like. And basically what we're looking for here is we're looking for points that it is below 30 or above 70 as indications of whether or not it is overbought or oversold. We are looking for time, also support and resistance levels around the 50 mark or around the center of this thing, and we can see that if we have a support level around 50 on the RSI, it goes overbought, it comes back to 50, it goes overbought, comes back to 50, close to overbought, over 50. In those cases we have uptrends. When the opposite applies, we have resistance around the 50 level. In those cases we have downtrends, and we can also look for sort of signs of reversals, pushes down through 70 or pushes up through 30 as potential buy and sell signals. Backtesting the stuff, we found it was relatively, well, I wouldn't say inaccurate, just unreliable. Sometimes it works, sometimes it doesn't, right? All right, we're going to go back to the left screen. So these are the things that I just spoke about, the various triggers that there are available for us to use on the RSI. Just hang on a second, something is wrong here. Moving on then to the next oscillator, which is the stochastic oscillator. All right, I just want to check if the stream is up. It seems to be, yes. All right. So the stochastic oscillator basically looks for a couple of different things here. Once again, we have a momentum indicator. It basically plots the location of today's closing price relative to the high and low range over a historic period of time, right? So it follows the momentum of price movement. So it looks at where's today's price relative to the trading range it's been over the last couple of days, and from that it bases it can indicate to us what momentum is doing, right? And for this reason, that it follows momentum so closely, is why we can use it most accurately for these divergence plays on oscillators, right? Divergence is something we'll get to in just a second. I don't know if the light is maybe a little dark in here. I don't know, who cares? Anyway, so we looked at this calculation. We have to work out the percentage K and percentage D line. Percentage K is the current close minus the lowest low